I'm speaking with Paul Saliba, Sector Head, Equities and Fixed Income at SQM Research. Paul, welcome. Thank you very much for participating in the Inside Network's Income and Defensive Assets Symposium.
Thank you, James. Pleasure to be here.
It's great to have you. How has the repricing of credit risk evolved over the last 12 months? And what are you seeing in terms of dispersion across sectors and issuers?
So it is an interesting question, James, insofar as in the private market, there's been a heavy inflow of FUM and assets coming in as investors seek to take advantage of higher yields. And as I speak to different managers, what I'm hearing is that there's probably deals being done at a lower rate than perhaps they would like to see. And I think that flow of FUM is trying to find a home, and I think that's affecting the pricing and the value, the yields that investors are getting. So you've got to be a bit careful. In public markets, I don't think the issues are quite as significant in that respect, because private markets tend to do what they do, and there isn't that sort of big switch into public markets, rather, in the same way as there has been in the private markets. And so I don't see a whole lot of issue there. Obviously, there's an expectation around Fed and central bank rate cuts more broadly, and that hasn't come into play because of sticky inflation due to tariffs and whatnot. And so I think there is a little bit of challenge there, not risk, but challenge, because there was some sort of expectation that prices would rise as interest rates were cut, and that hasn't come to play. I'm sure it will. I think rates are probably at peak, and inflation is looking pretty reasonable.
You mentioned inflation proving stickier than expected. That's certainly been the case. How should advisors think about managing real income and duration risk within client portfolios?
Yeah, I think that stickiness, if you look at an inflation chart, and it almost doesn't matter which one, whether it's US, Australia, parts of Europe, it has been stickier than people expected, but it is an inverted V. It's gone up, come down. It doesn't do straight lines. It didn't actually go up in a straight line. There were some bits where it went sideways for a little bit, and we're seeing that now. And I think Trump has exacerbated the fact that it's not coming down in the straight line. So I don't think you need to worry too much. I think whilst it might flatten out at a higher level than what we're used to post-COVID, post-GFC, those sorts of very low rates, and we probably won't go back to there unless there is a significant exogenous shock. I think you can still invest in fixed income markets knowing you're getting a higher yield. Interest rates are likely to come down. They're just delayed in the cuts that'll come through. And so you're getting a yield. So if prices don't move, you're getting paid to be there. In private markets, you're being paid even more to be there. And if rates do come down, then you get an uplift on the capital side in due course. But that's not really what you're there for. Obviously, if there's an exogenous shock and we have a recession, the recession will be a trigger to cut rates. How low that goes, anyone's guess, and I'm not going to try and guess that, but it'll be substantial cuts, and that's when we have a much more substantial cushion on the defensive asset side than we've had pre-COVID and after COVID.
In your view, what are current market conditions implying for forward-looking returns for fixed income? And have we reached the top of the rate cycle, or is there still uncertainty ahead?
I think there is uncertainty, and that revolves around the Trump negotiations as he continues to work out where the tariffs land. Tariffs are landing a whole lot higher than what they were pre-Christmas and pre-Trump coming into office. And so I think that is a reason why the rates don't come down perhaps as fast and as much as otherwise we were expecting. I think from a market perspective, that means investors, it's a bit challenging because growth assets are very expensive in many areas. Defensive assets, I heard someone say just recently bonds have been uninvestable for some time. I don't think that's quite the case, but they're not quite as, I suppose there's not the same confidence as there has been in the past. And when rates are coming down rapidly, obviously you get a lot of uplift in prices. And so I think there's a little bit of caution there. And I think that's part of the reason why there's so much attraction to private debt, because they're not affected as much, and they've got the higher yield. So you're getting paid 7, 8, 9, depending on what part of the market, even into double digits. And so you can kind of diversify your defensive asset with the private market stuff that allows you to collect a very substantial yield.
There has been such a proliferation of fixed income vehicles across areas such as ETFs, managed funds, private debt. How should advisors weigh up liquidity, transparency and credit quality when they're trying to choose from this much broader universe and menu of fixed income vehicles?
I think the menu and the diversity there is actually really good for advisors. I think one of the challenges for them is around the liquidity. You generally don't need the liquidity until you do. I pose to a manager the proposition that even if I'm a long-term investor, if I buy a product, whatever it is, and I hold it for 10 years, and then I'm downsizing or maybe I pass away and the assets need to be sold to hand on to the next generation, there comes a point when assets need to be sold. And so it doesn't matter how long you've owned it for beforehand, that is a liquidity event that you need to enact. And so the challenge there is how much your liquidity any one individual client of an advisor can handle. And obviously the younger you are, the more. You don't actually need liquidity in your superannuation fund when you're my age or younger, and I'm 52. So do you need liquidity? Well, I can't touch the money for another 10, 8 years, depending on circumstances. So I don't really need the liquidity. So I can have a reasonable amount of illiquidity. And I think that will need to be worked out client by client. And the beauty of the products that have come to market is you can buy these vehicles through ETFs. You can buy them in unlisted funds, and it depends on what suits you and what you like and whether you want to pay brokerage or whether you want to have spread and so forth. And so there is a lot more opportunity set, which I think is good for the market.
Looking ahead to the next 12, 18 months, Paul, what major trends do you expect to shape the fixed income universe, and how should advisors position defensively while still targeting yield?
Yeah, I think that's interesting because, there's this, and it has been for some time, an expectation that we're going to have an economic slowdown and possibly recession, and those probabilities rose. I think they diminished a bit, and then I think Trump's made the probabilities rise a little bit more again. And so it's how defensive you want to be. Picking markets and timing, all that sort of thing is very, very difficult. And I think Peter Lynch said famously that more money's lost in preparing for these things than actually in the event, and that's because you miss time on the getting out. You get out too early, markets continue to rise. You come in too late, and you actually miss out on more than you would have done if you just held through. So to me, it's about having diversity. To me, you can defend a little bit extra at the moment. There are some valuation in equities. We know that tech and all that sort of stuff, the high growth stuff, but there's a lot of defensive assets, traditional bonds, public market credit, and then there's the private credit. And if you combine those in a sensible way, you can get the yield, you can have the capital side when rates get cut, and if they get cut significantly through a recession, then that will really come into play. But otherwise, a broad exposure across those different areas, subject to the liquidity, comfort of the client and their stage of life, I think will put them in a good position.
Paul Saliba, SQM Research, thank you very much for your time today.
Terrific. Thank you, James.